You might not care about Japanese bonds, but you should, because the Japanese government bond market is quietly becoming one of the biggest risks to global finance. Here's why I'm watching it closely. For decades, Japan has been the world's biggest creditor nation. It lends more money abroad than any other country, through its pension funds, insurers, and megabanks. And all of them depend on one thing: stability in the Japanese bond market. Now, that stability is fading. In 2016, the Bank of Japan introduced something called yield curve control, or YCC. Under it, the BOJ promised to cap the 10-year government bond yield near 0%. It basically said, we'll buy unlimited bonds to keep yields low. That worked for years, until inflation came back. Japan's inflation is now around 2.8%, the highest sustained level in 30 years. To fight that, in March 2024, the BOJ ended negative rates and scrapped yield curve control altogether. That's when the bond market started to shake. When a central bank stops capping yields, bond prices fall fast. And that's what happened. The 10-year JGB yield jumped from 0.6% in early 2023 to around 1.1% in October 2024, the highest since 2012. That may not sound like much, but in bond markets, that's huge. Because Japan has the largest public debt in the world, over 260% of GDP, or roughly $9.5 trillion outstanding. Even a small rise in yields means a massive increase in debt servicing costs. So here's the problem. The Bank of Japan used to be the buyer of last resort. But after ending YCC, they're buying less. Now, the market has to absorb more bonds. Who's going to buy them? Domestic investors like life insurers and pension funds already own too many. Foreign investors don't want them. The yields are still too low compared to US Treasuries. And that's why auction demand has started to weaken. The October 2024 30-year JGB auction saw the lowest bid-to-cover ratio in over a decade. If this continues, Japan faces a dangerous feedback loop. Higher yields mean higher interest costs, which mean more debt issuance, which pushes yields even higher. The Japanese Ministry of Finance already warned in June 2025 that bond market volatility could threaten fiscal stability. Now let's talk about why this matters globally. When Japanese yields rise, Japanese investors start pulling money back home. They sell US Treasuries, Australian bonds, European assets, anything, to reinvest in Japan, where returns are finally positive again. This is called the reverse carry trade. And every time it happens, global yields spike. It's one reason US bond yields jumped in mid-2024, right after Japan hinted at ending YCC. Think about it. If Japan, the world's largest bondholder, starts selling instead of buying, the entire global debt market reprices. And if yields keep climbing, Japan's own banks, which hold around 450 trillion yen in government bonds, start taking paper losses. Financial System Report 2024. That's why the JGB market isn't just a local issue. It's a global signal. Here's what I'm watching. If 10-year yields break above 1.8%, that could trigger another sell-off. If the yen drops sharply while yields rise, it means capital is leaving Japan, not entering. If the BOJ restarts large-scale bond purchases, it means the market couldn't function without them. In short, Japan's bond market is quietly testing the limits of modern monetary policy. The world got used to free money. Japan is the first to step away. If it breaks, the shock won't stop at Tokyo. It'll ripple through every major bond market on Earth. That's why I'm watching it every week.